Welcome back to the Retirement Planning Made Easy.com show. I'm your host, as always, Chris Hammond. This is a show for retirees and people that maybe you want to be retired in 10 to 15 years, and you're just worried about the stress, the anxiety of wondering, am I making the right decisions on my investments? Am I minimizing taxes? Have I saved enough to retire? We talk about all of that on this show. Now, today's episode, I want to talk about one of the biggest mistakes that investors make as they get closer to retirement. And when it comes to retirement investing, it's kind of like you're threading the needle. You don't want to stray too far to the left or to the right. There's this straight and narrow path to retirement investing. And what I mean by that is that when you are investing in retirement, and even when you're getting near to retirement, things start to change a little bit than what they were like when you first started working in your early years of your career. But when it comes to retirement investing, you have to take care of the you that's going to be around 20 years from now. But at the same time, you also have to take care of the you that is right now. What I mean by that is that when you retire and you're no longer able to rely on your salary to live on, you have to find other income sources to live on. Now, for most people, Social Security is going to be one of them, but also for most people, Social Security is not going to be enough. And a lot of people are not going to have access to pensions either. And even if they did, the pensions, they're typically not inflation adjusted anyway. So even over time, their purchasing power goes down. So you have to take care of the you that lives today, right now. And that means making withdrawals from your portfolio for most people. But you have to also not only generate that income, taking those withdrawals today, but you also have to be investing in such a way that your money is growing over the long term so that the you that's going to be around 20 years from now is going to have access to funds that they can tap into to take care of themselves then. So you have to walk this straight and narrow. You're threading the needle between these two objectives that have to be done. If you go too far on the side that's trying to get a lot of growth for the future, then you're going to be at a lot of risk at that point of when you're taking those withdrawals currently for income. If the market's gone down, say 20, 30, 40%, something like that, and you're invested very aggressively, your portfolio may also be down that much. And if that's the case and you're taking withdrawals from it, you can get into some serious financial difficulties for your retirement at that point. And really getting into those difficulties at one of the points in life when you really don't want to be in that type of a situation. Because once you retire, the money you've got that you've accumulated, short of winning the lottery, that's really what you've got to work with. And so you don't want to take those big losses. So you have these two things you got to take care of: growth for the future, 20 years from now, and income for today. So let's look at how people that are in their early careers right now, and even back when you were at that time of your life, let's look at like what's important to them when they invest. Well, for them, growth is the most important thing. They want to build up their portfolio. They have decades before they're ever going to have to tap into those funds. So they can handle it when the market takes a nosedive because they're going to be able to just sit tight. They're still living off of their salary. So income investing for them is not very important. They're living off of the wages that they're currently making. That's early career investing. Now, as people move on in their working years and then they're in their mid-career, growth remains important, but it also becomes important that they're not taking as much risk and having all the volatility because they do know that if they're going to retire in 5 years and they're still taking a lot of risk, sometimes it can take the market a good number of years to rebound back from a dip. And so that could impact them having enough money on the day that they do retire. So reducing that volatility, that becomes more important, even in mid-career. But at the same time, mid-career, you're not relying on the earnings and you're not relying on taking withdrawals from that portfolio yet because you're still living off of your salary. So you have that going for you. So now let's talk a little bit about retirement investing, because that's where things start to change up. But before we do talk about that, I want to just give you the opportunity to know, if you haven't already, go over to my website, retirementplanningmadeeasy.com. I've recorded a webinar called Reaching Retirement and Thriving Beyond, how a customized financial strategy helps you overcome the three main threats that you will face in retirement. These are the threats that virtually all retirees are facing. And in that masterclass webinar, I go over what those threats are and what you can do to help overcome those as well. So going over there after this, retirementplanningmadeeasy.com, and you can instantly get access to watch that very helpful webinar. All right, so let's talk a little bit about retirement investing. When it comes to retirement investing, you might be surprised, but growth is still important. Growth is the part that's taking care of the you that's going to be around 20 plus years from now. If you don't have that growth, and what's going to get you, inflation's going to eat away at your earnings, eat away at your purchasing power of your nest egg if you don't keep pace with inflation. So that's why growth is still important even during retirement. Now, reducing volatility becomes even more important. And the reason why that is for two reasons. It's harder to weather out the storms because you have less years ahead of you to bounce back, like somebody who's just 25 years old does. But also because a lot of retirees find that Social Security does not cover all their expenses, and they have to live off of that nest egg. They have to live off their savings and draw money down from that. Well, what happens if your portfolio is down 40% because you're invested too aggressively? You have too much volatility in it. You're taking too much risk, but you still at the same time have to make those withdrawals just for your regular lifestyle expenses, groceries, utilities. I know it's a luxury, but we don't like to put off even going on vacation either, if we want to just be really honest about things. So that's where reducing volatility becomes even more important when you're in retirement and you're making those withdrawals from your portfolio. So the big mistake that investors make as they're nearing retirement is that your needs change over your lifetime, but a lot of times investors do not change how their portfolio works and how it's allocated to meet you where you're at this point in life. That's one of the biggest threats. Your goals, your phase of life that you're in, it demands you to have a portfolio that's going to serve you better at those goals. And if that requires taking more income from your portfolio, then it needs to be structured in such a way that it can do that in a very efficient way, in a way that you can reduce volatility to help you not run out of money in retirement. Now, what's kind of paradoxical is that higher growth portfolios can sometimes leave you with less money if you're taking withdrawals from that portfolio in retirement. Let me say that again. Higher growth portfolios, while they should be able to grow your money more, they have higher returns on average. It's possible that they can actually leave you with less money in retirement when you are regularly taking withdrawals from that portfolio. Let me give you an example with this illustration I call Hans and Franz. So Hans and Franz, they both retire. They have $1 million each, and they have to withdraw 50,000 from their portfolio each year just to cover their lifestyle expenses. So Social Security covers some, but it doesn't cover everything. So Hans, he has $1 million, and he looked at his Social Security and he determined, I need 50,000 extra every year. Franz, he has $1 million, and he determined that same thing. Hans decides to go for a higher growth portfolio. His average return on his portfolio is 8%. And he's willing to take a lot of risk to do that. Remember, we get rewarded our returns, we get rewarded for the risk that we take. That's how modern portfolio theory works. So Hans withdraws 50,000 a year. After 10 years, he's withdrawn $500,000, and he ends with $900,000 approximately left in his account. So Hans did pretty good, not too bad. Now, Franz, he took a different road. He took actually a smarter path. He said, I'm not as concerned about having a high of growth, so I'm going to take a lower average rate of return of 6%. but his returns are a lot more consistent than what Franz's were. So after 10 years of taking 50,000 a year out, he's taking half a million out. He ends with about $1.2 million, about $300,000 more than Franz ends. Now, than Hans does. Now, Franz took risk. He wasn't just investing in bank CDs or government bonds or treasuries or something like that. He took risk. You can see there's some years where he lost money. But if you look at overall, the consistency of his returns was a lot tighter. So when he was taking those withdrawals, he wasn't in a situation like Franz was, where he had lost already by the third year. His portfolio had gone down about 33% or so. And so he wasn't in that situation to be further taking withdrawals that further push down that portfolio. And because of that, he comes out better. Because in Han's situation, when those big growth years do occur later on, he's already lost a lot of money. He's already withdrawn a lot of money that's not going to be there to experience that high growth anymore. Now, what if Hans and Franz weren't taking withdrawals from the portfolio? What if they were just they were like early career investors, people in their 20s, 30s, and they weren't taking any withdrawals? Hans would have come out better, but because they were taking withdrawals, Franz does better. And it's because he has a lower risk, lower standard deviation, and a more consistency of returns over his portfolio's life. Now, the bottom line then is that to avoid that big mistake that investors make all the time is your portfolio should serve your needs at whatever phase of life that you are in. If you're still investing in a way that was appropriate at an earlier phase of life, but maybe not appropriate now, then you may be making that big mistake. And so your investment should reflect your needs that you have currently. And those needs are going to change over time as your circumstances change. And one huge circumstance that changes for everybody is the approaching of your retirement date. That changes everything because you suddenly go from living off your salary to now you're living off of your savings, drawing money from your savings, at least the part that Social Security doesn't cover. So the big question on the bottom line is your portfolio still serving your needs? Because if it isn't, probably want to take a look at that because you could be setting yourself up for some really bad financial consequences in retirement if you don't have this allocated appropriately for what you need. That's all I've got for you for today. If you haven't had a chance, head on over to my site, retirementplanningmadeeasy.com. I've got a link on there where you can instantly watch a masterclass webinar that I did called Reaching Retirement and Thriving Beyond, how a customized financial strategy helps you overcome the three main threats that you will face in retirement, where I will go over those three main threats with you and I'll show you things that you can do to help overcome that. That's all I got for you guys today. I'll see y'all on the next video.